Equity Market Update, October 2020. After showing positive momentum during the first half of the month, Nifty 50 moderated in the second half, but still ended the month 3.5% higher than the last month. The movement in equities was influenced by uncertainty around US fiscal stimulus and presidential elections, rising number of infection in US and Europe, imposition of restriction in many European countries, sequential improvement in economic activities, etc. The large caps outperformed mid caps and small caps during the month. Amongst the sectoral performance, banking, IT and power were the best performing sectors, while healthcare and auto underperformed during the month. Globally, most major indices delivered negative returns during the month. FPIs bought equity worth $2.7 billion in October 2020, as compared to being net seller of $1.1 billion in the previous month. Net FPI inflows into equity in 7M FY21 stood at $12.8 billion as against net inflows of $3.1 billion in similar period last year. Recently, MSCI announced that it is going to consider changes in the foreign ownership limits in the MSCI global indices for Indian stocks in November 2020. Analysts estimate that it can result in incremental inflows of $2 to $5 billion. Domestic equity-oriented mutual funds witnessed net outflows of INR 3,079 crore in September 2020 compared to net outflows of INR 6,056 crore a month ago. In the first 6 months of FY21, net outflows from domestic equity-oriented mutual fund schemes stood at approximately INR 10,267 crore, as against net inflow of INR 33,432 crore during the same period last year. Out of the Q2 FY21 results declared so far, results of IT, cement, financials, metals and consumer staples were better than expectations. Results of auto, oil and gas and industrials were largely in line with expectations. Outlook. As on 31st October 2020, Nifty 50 was trading at price to earnings multiple of 24.6x based on FY21 estimated earnings, and 18.7x based on FY22 estimated earnings. In our view, these are reasonable multiples, especially given the low interest rate environment. Further, multiples ex consumer staples, financials and communication services are attractive, and few of the sectors are available at significantly below long-term averages. Again, as of 31st October 2020, the Indian market capitalization to GDP stood at approximately 74%, lower than its 10 years average. Also, the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield continues to remain below its 10-year average. This further indicates that equity markets are attractively priced. It should also be noted that while Nifty 50 has recovered significantly from lows seen in March 2020, the recovery is polarized, with top 5 stocks contributing a significant portion of the gain, and broader market is still quite attractively valued and thus holds promise over the medium to long term in our opinion. Strong sequential improvement in economic activity, favorable external scenario, monetary and fiscal measures undertaken along with relatively better placed rural economy also supports this optimism. In view of the above, in our opinion, there is merit in increasing allocation to equities in a phased manner, or in staying invested as the case may be for those with a medium to long-term view and in line with individual risk appetite. Significant rise in spread of COVID-19, unwinding of expansionary fiscal and monetary stimulus, sharp rise in crude oil prices, higher than expected NPAs post the moratorium, escalation of border tension between India and China, and/or trade tension between US and China, significant policy changes post-US elections, etc., are key risks in the near term. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.